To make it easier to see this presentation, you can maximize your screen by clicking the little box that looks like this in the bottom right-hand corner of the video. So go ahead and click that icon now, and we'll get this webinar started, hosted by Darren Sugiyama and Lionsmark Capital. We hope you enjoy this presentation.
I'm Darren Sugiyama, CEO and founder of Lionsmark Capital, the most transparent premium financing intermediary firm in the life insurance industry. So last year, my wife was talking to my 81-year-old mother about her cell phone plan. And when my mom told her how much she was paying, my wife immediately called the carrier to find out what plan she was on. It was clearly an old, outdated plan that was way overpriced. And that simple phone call saved my mom about $40 per month, which, it doesn't sound like much, but over the year, that's $480. Over the next few years, that'll save my mom a couple $1,000s. So the question is, why didn't the cell phone carrier call my mom, several years ago and just, redo her rate or readjust her rate, I should say? Well, I think it's pretty obvious that the carrier was making an above market spread, which was pure profit for them. And my 81-year-old mother wasn't shopping the market every year. She just had her bill on auto pay and really didn't realize that she was getting overcharged. Well, that's what's happening right now with a lot of premium financing loans. I can't tell you how many loans I've seen in recent past that are renewing way above market. And no one's keeping their eye on the ball either, refinancing these loans at a lower rate. Now, you may be saying to yourself, yeah, but Darren, everyone knows rates have increased over the last couple of years. And that's true. But I can tell you that I see a big variance in renewal rates every day. And some of these increased renewal rates are priced at, fair market rates, and some are way overpriced. And I think some of the lenders out there assume that the clients and the advisors won't question them on their rates, simply because they know that everyone knows that rates have, gone up. So no one really questions it. How do I feel about that? Kind of feel like it's not really a pro-consumer type of stance to take. And I'm telling you, there are so many premium financing loans that aren't being serviced properly either, especially when it comes to renewal rates. You see, in my opinion, it's really the premium financing intermediary's responsibility to make sure that their client is getting the best lending rate and the best lending terms every year at renewal. But what I'm finding is so many clients have been really put on autopilot, kind of an autopilot type of path. And it's really, again, in my humble opinion, really negligence on behalf of the premium financing intermediary. You can't expect the lenders to give you the best and lowest rate on their own. You really need a premium financing advocate working on your behalf and on your client's behalf. So that's why I've started a new division of Lionsmark Capital called Loan Lab for premium financing cases that were financed several years ago through a different intermediary. Back before you realize Lionsmark Capital is really who you should have been working with all along. but in all seriousness, if you have in-force premium financing cases that are renewing at borrowing rates north of 7%, you should really see if we can shop the market and find you a better rate. Obviously, we charge an origination fee to do this, but what I'm going to show you in this webinar is really what our Loan Lab capabilities are. So really, what is Loan Lab, and why do we call this a new division of Lionsmark Capital? Well, again, we look at premium financing loans in a way that a scientist analyzes and tests different scenarios in a laboratory. We've created a platform that compares your current/renewal rate to whatever our best lenders offer is. We work with over a dozen different lenders, and part of our job in our core premium financing business is to find you the best borrowing rates and the best loan terms. So I figured, you know what, there's probably a ton of existing premium financing loans out there that could use our expertise in premium financing lending and refinancing. And if there is a better option, it would only make sense to refinance the loan at a lower rate. There is literally no other platform like Lionsmark Loan Lab out there. In this webinar, I'm going to review a case study of a loan using our loan analytics so you can see just how much we can save a client on the loan interest rate. So let's go ahead and get started. So this case comes to us as the client is renewing, rolling into their third policy year. And the current loan balance with their current lender is just over 3.9 million. The current lender was using SOFR as their loan index, which was 5.31% at that time. And they were adding a 2.50% spread on top of SOFR, making the borrowing interest rate 7.81% at renewal. So what we did is we modeled the remaining 5 years of scheduled premium, which was just over 1.9 million per year. And we ran the interest payments out until the presumed loan payoff using the policy value. So between now and then, policy years 3 through 12, the total interest outlay is projected to be $9.1 million, assuming their current loan rate where they were renewing. Now, of course, rates could increase or decrease over time, but this is just a model for comparative purposes. Now, on the right-hand side of the screen, we're charging an origination fee of 1% of the refinanced amount, and the new lender is charging a loan doc fee here of $5,000. The new lender uses 12-month CME term SOFR as the base index, which was 5.06% at the time, and they add a spread of 1.80%, putting the total loan rate at 6.86%. Now, kind of like my mom's cell phone bill savings, it doesn't look like much on the surface, but over time it really adds up. So here we see in year one, the new annual premium being borrowed, and we're showing our origination fee and the lender's loan doc fee being capitalized into the loan. And the client is paying interest only on the loan balance each year at the lower borrowing rate, all the way up until loan payoff. So over the course of the next 10 years, the total loan interest outlay is projected to be at 8.1 million instead of 9.1 million, which saves the client a little over $1 million in loan interest. That's an 11.69% in total interest savings over that period of time, even with our origination fee built into the pricing. I think that's pretty substantial. So if you have a client whose premium financing loan is renewing, and you're being quoted a rate north of 7%, you might want to have us take a look to see if we can shop the market for you and come up with better loan terms by refinancing the loan with one of our dozen plus lenders. If the numbers make sense for the client from a mathematical standpoint, even with our origination fee, it kind of becomes a no-brainer. Now, you may be asking yourself, how is Darren able to get such favorable borrowing rates? Well, part of it is simply because I'm awesome, but really, part of it is understanding how banks set their borrowing rates. You see, most lenders price their loans based on a particular index, like SOFR or CMT, and then they add their spread on top of that. And their spread is really based usually on a grid, meaning that the bigger the loan, the lower their spread. Now, each lender is a little bit different in this regard, but the spread usually decreases every $500,000 or so in annual borrowed premium. So if you think about it this way, if the annual premium at policy inception was $700,000 a year, the lender would price the loan based on that $700,000 annual premium. But once the client is into their loan, say 5 years, that loan balance is now $3.5 million. That's the $700,000 in annual premium borrowed times 5 years of borrowing. But if I refinance that existing $3.5 million loan, my new lender is going to price that refi, assuming the $3.5 million amount, not the $700,000 amount, as it pertains to their pricing grid. Again, their current lender typically does not reprice the loan interest rate as the loan balance gets bigger, which is why my refinancing platform can be so valuable to both you and your clients. So if you have a premium financing loan renewal and you'd like me to take a look at it, go to Lionsmark Loan Lab. That's the domain name right below there, which is the new website that is specifically designed to refinance overpriced premium financing loan renewals. We're really the only one in the industry that's doing this, that has enough relationships with enough lenders, and I'm talking about a history of relationships with these lenders for several years, where we can offer this type of service. Anyone else in the industry that says they can do it, you might want to check out their references and their history of working with all of the lenders that we work with. We will not be beat in terms of rates. So as always, I look forward to doing some great new premium financing cases together. But for your existing renewing premium financing cases and your loans, maybe there's a way for us to collaboratively benefit your client together. So I look forward to working with you guys on several fronts. This is Darren Sugiyama signing off. Hope you enjoy the rest of your day.